Welcome to This Explainer. Today we're tackling a money trap that, well, almost everyone falls into at some point. Picture this, right? You're working hard, you're paying your bills on time, and you finally decide, okay, it's time to do the responsible thing with my cash. You're absolutely determined to build that rock-solid financial foundation step by step.
Okay, let's dive into this. You set up that automated transfer, or maybe you're doing it manually every time you get a paycheck. You start moving a little bit over into your savings account. Maybe $100 here, $200 there, and month after month, you watch that balance slowly creep up. Honestly, it feels great. You feel super responsible, disciplined, like you've really got your financial life together. You're doing exactly what everyone always told you to do, which is save your money. But then, one day, you open up your banking app and this really frustrating reality kind of sets in. You realize something incredibly strange. Let's say you've got $10,000 just sitting in that savings account, but it's earning something tiny, like 0.5% interest. I mean, do the math on that. It means after leaving $10,000 completely locked away for an entire year, he's made a grand total of $50. $50. Meanwhile, you hear everyone else talking about stocks and index funds and compound growth, and it hits you. Saving alone, it rarely builds actual wealth.
Section 1, the savings illusion, half the race. See, we often think that just putting money in the bank means the job is totally done. But that's an illusion. The truth is, you've really only finished half the race. Here's the fundamental difference, clearly defined for us. Look, saving is absolutely crucial, no doubt about it. But saving alone will almost never make you wealthy. It's not the final goal, it's simply the first stage. Because fundamentally, these two actions have completely different jobs. Savings exist to protect your money. Investments exist to grow your money. If you only ever save, it's kind of like you're playing defense for the whole game without ever putting your players on offense. Section 2, the math of wealth. Numbers don't lie. And this brilliantly illustrates exactly what I mean. When you look at the raw mathematical reality over a 20-year timeline, that savings illusion just completely falls apart. Let's start with that same 10 grand. That first bar, that's your typical savings account earning maybe 1%. Over 2 whole decades, it grows to about $12,200. But look at that second bar. Historically, the stock market has returned about 10% per year on average over those long periods. That exact same $10,000, if you invest it, turns into roughly $67,000. It's the exact same starting money, but a totally different universe of an outcome. The biggest wealth gap out there isn't usually between people who save and people who spend. It is literally between people who save and people who invest. Section 3, the psychological hurdle, fear versus math. So, if the math is that obvious, why doesn't everyone just invest? Well, it really comes down to raw human emotion. And honestly, it makes perfect sense why you might feel a little afraid. Think of your savings as safety money, right? It's predictable, you can easily pull it up on your phone and see it, it's totally static, and it definitely doesn't just randomly drop 5% on a Tuesday afternoon. Growth money, on the other hand, refers to your investments. It fluctuates, it's volatile, it moves up and down, and not an emotional roller coaster, it scares people away. They just don't want to lose the cash they worked so incredibly hard to save.
I absolutely love this analogy because it perfectly reframes how we should be looking at our money. Saving is like storing seeds in a glass jar. You're protecting them, sure, and you can see them clearly right there on the shelf, but nothing grows. Investing is like taking those exact same seeds and planting them in the dirt. At first, it looks incredibly messy. The seeds literally disappear from view, and you don't see any results right away. But over time, way beneath the surface, things are working. And eventually, you grow something far, far bigger than those original seeds you started with.
Section 4, the step-by-step path, stages to wealth. Now that we understand the psychology and the math behind all this, how do we actually do it? So the crucial point is following a really clear, low-friction framework. Step 1, before investing a single dollar, you've got to build a real emergency fund. We're talking 3 to 6 months of living expenses, in cash. This is what protects your investments from life's sudden surprises, the random car repairs or unexpected medical bills. Step 2, separate the money mentally. Keep your safety bucket and your growth bucket distinct in your head to reduce that anxiety. Step 3, start small. You do not need thousands of dollars. Just start with $50 or $100 to build a habit. And step 4, focus on simple index funds. And to really drive home that fourth step, let's look at what the heavy hitters say. You might think you need to jump straight into crazy complicated strategies, right? Day trading, options, or crypto speculation to make real money. But the great news is, legendary investor Warren Buffett has repeatedly recommended simple, low-cost index funds for most investors. These funds just track the overall market. They invest your money in hundreds of companies all at once. That gives you instant diversification, way lower risk, and that steady long-term growth we're looking for. Section 5, the compounding engine, discipline and time. Once you have those core steps in place, you unlock something incredibly powerful. Let's shift our focus to the long-term mechanics of consistent investing. I mean, just look at the sheer scale of this compounding magic. Let's say you consistently invest just $300 a month into the stock market for 25 years, assuming an average 8% return. You end up with roughly $285,000. Now, what's really interesting about this slide is the slices of this chart. That blue slice, that's what you actually contributed out of your own pocket, just $90,000. But that massive green slice, almost $195,000, is pure investment growth. The growth is doing the heavy lifting here. It's literally more than twice as big as your actual out-of-pocket contributions. Of course, to get that massive growth, you've got to survive the downturns. So what happens when the market crashes? Well, the reality is market crashes are completely normal. They happen. But the key insight here is that temporary drops are actually massive opportunities. When the market drops, your consistent monthly investments are suddenly buying way more shares at much lower prices. It's basically a massive sale. And when the market inevitably recovers, those cheaper shares lead to much stronger returns. You really just have to stay disciplined and remember to think in decades, not days. To summarize the core philosophy of everything we've covered today, saving gives you stability, but investing gives you freedom. You absolutely need the stability of that emergency fund to survive the present, but you desperately need the growth of investments to secure your future. The earlier you combine these two forces, the more powerful your financial timeline becomes. So I want to leave you with this final thought as we wrap up this explainer. Take a hard look at your own financial timeline right now. Are you currently stuck in the saving stage, carefully protecting your seeds in a little glass jar? Or have you already started planting them and moved into the investing stage? Really think about what your next step needs to be to make your money work exactly as hard as you do. Thanks so much for joining me, and I'll catch you in the next explainer.